Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 3rd of January. I'm Daniel Lam, your host for the podcast. Yesterday, I spoke to a friend from the industry who is a fixed income expert. He believes that this year would be a smoother ride for global fixed income, and I would tend to agree on that. The main point has actually been highlighted in yesterday's podcast, and that is inflation. It's expected to be edging lower, and policy rates appears to have peaked. So therefore, the Fed is likely to be easing sometime this year. And that effectively means the US 10-year government bond yield is likely to be edging lower. So it was showing a higher high and higher low pattern that was predominant in 2023. But this year, it may show a lower high and lower low trend. And that means the US 10-year government bond yield is likely to be coming off. And of course, that's favorable for bond investors. They may add to their positions accordingly when they see pops in yields. Our preference lies in high-quality bonds for their attractive yields and the likelihood of prices rising further as DM economies weaken in 2024, which may push yields lower still. And that's despite the sharp falls in yields that we've already seen in the last quarter last year. We're overweight DM government bonds and expect the US 10-year government bond yield to soften further to 3.25 to 3.5% over the next 6 to 12 months. And we prefer an average US dollar bond portfolio duration of 7 to 10 years. Now, in emerging markets, our expectation for EM currencies to remain well supported against the US dollar should offer support for local currency bonds. But we do note that markets are already pricing in several rate cuts for most major EM central banks over this year. This suggests that rate cut optimism may already be priced in, leaving yield and currency appreciation as the main drivers of returns. So this balanced outlook leaves us with a neutral view on EM local currency government bonds. And finally, before I sign off, a word about Asian US dollar bonds. We are neutral on those, and within that, we prefer Asian high-yield bonds over IG bonds. The sharp fall in Asian high-yield bond prices, the one-sided sentiment, and increasingly expensive IG bonds have shifted the relative risk-reward in our view. Asian high-yield bonds are now offering a yield of around 15%, which lies amongst the 95th percentile of the past 10 years. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.